Hello again, everyone. Welcome back. Thank you for watching. I want to start off this week with going back to last year. And if you remember this story, Kelowna residents charged in alleged $7.8 million Ponzi scheme. Police allege investments were presented as real estate flips. What they did was take people's money, saying they were flipping real estate, and of course, they embezzled the money. This was a real Ponzi scheme. They had no intention of ever flipping real estate. So this is as pure as it gets. It's like first degree murder. You went there with the intent of killing people. These guys went with the intent of defrauding people by the alleged charges against them. And just before I get started on this week's first topic, I just want to read what is a Ponzi scheme. You probably know where I'm going with everything that's happened in the last week or so. You've read multiple stories in the news, but I want to go and give my own take on it. So let's just read this real quick, and I'm going to move on to the important stuff. A Ponzi scheme is a fraudulent investing scam promising high rates of return with little risk to investors. A Ponzi scheme is a fraudulent investing scam which generates returns for early investors with money taken from later investors. This is similar to a pyramid scheme in that both are based on using new investors' funds to pay the earlier backers. So, okay, now I'm going to get into a story from last week. There is no evidence that this was a Ponzi scheme. There is no charges of fraud yet. Maybe there will be, maybe there won't. So this is just my opinion, but I want to make some correlations here. And of course, I've referred to real estate as a pyramid scheme, at least recently in the most recent years. But anyway, let's read this article. And again, I'm not making any allegations against the parties to this. It's still under the court's review. And I'm just giving my opinion and making some comparisons, like I said. So from CBC News last week, I believe this was the initial news station or news organization that broke this story. 3 landlords among largest real estate holders in Ontario owe $144 million under bankruptcy protection documents. The investor, based in Hamilton area, faced 32 creditor lawsuits for unpaid loans. Dylan Suter, Ryan Maloney, and Aruba Butt are behind 11 now insolvent corporations that face a liquidity crisis with only $100,000 in the bank, the documents say. Along with owing $144 million for mortgages and other loans, they owe $2.8 million in unpaid municipal taxes, utility bills, and corporate income taxes, $600,000 to contractors, trades, and service providers, $55,000 in payroll deductions to the federal government. So far, it just looks like some really bad management and people that were being a little reckless or very reckless with their business ongoings. Last August, Suter hosted a business results training seminar in Burlington, Ontario, promising attendees would learn to grow their business with up to 150% over 12 months, according to his social media posts. Now back to Investopedia. Companies that engage in a Ponzi scheme focus their energy into attracting new clients to make investments. Otherwise, their scheme will become illiquid. Again, no claims of a Ponzi scheme here. This was from the Globe and Mail. One day later, former YTV child actors Northern Ontario real estate empire files for insolvency. To finance these purchases, the companies obtained more than 390 mortgages worth $89 million, 120 second mortgages worth $8 million, and 802 unsecured promissory notes worth $54 million. So that's a lot of promissory notes. And of course, a promissory note there's no collateral. If you don't pay them back, they can't do anything besides try to take you to court, small claims, whatever court it is, depending on the amount, and try to get their money back. So a promissory note is a very bad investment and a very risky investment to give to somebody. Back to Investopedia. The SEC has issued guidance on what to look for in potential Ponzi schemes, including guarantee of returns or unregistered investments with the SEC. The interest rates on these loans and promissory notes vary between 8% and 20%. 20% on some of these loans, that's a pretty big promise and a pretty big return. And again, it's in an unregistered and uncollateralized investment. So yeah, high returns, promises of high returns, right? One private lender who spoke to the Globe and Mail said she feels misled and she wasn't kept in the loop on the scale of the operation she was lending to. At no time were we told that they are part of this conglomerate of all these companies. We would never have done that. said Kathy Hugh, 57, a retired bank employee living near Ottawa. Miss Hugh loaned $184,000 at 8% interest in 2022, what she believed was a sole operator to purchase a single family home in Sault Ste. Marie. I only wanted to do individuals. I felt more protected because I could have gone in for a repossession. Back to Investopedia. The Ponzi scheme generates returns for older investors by acquiring new investors who are promised a large profit at little to no risk. So, of course, there's a lot of red flags in this story and in this situation. Did these guys start off meaning to do a Ponzi scheme? Not saying it is, but of course they didn't, right? They didn't. They started off investing. They were reckless. They started taking other people's money as promissory notes because they got desperate. So it wasn't a first degree murder kind of Ponzi scheme. It was like second degree or manslaughter, right? They got so far, and again, this is my opinion. You got so far into it, you don't want it to fail. You get desperate. You start making promises, holding seminars. Come invest with us. Look, we'll give you 8 or 20% return. Giving someone 20% return or promising that on real estate investment, it's pretty reckless. And of course, that can't last unless you expect real estate to appreciate at 20% a year. Maybe they got caught in the market, but again, it's reckless to think that the market was going to be 20% or 10 or 20% a year. So this next part of the story is what really irks me and gets me angry, and it's what I talk about all the time. And anyway, I'm just going to read it, and you can see what I mean. Mr. Clark's business, and he was one of the investors or one of the three, model of buying and renting mainly single-family homes bears resemblance to one employed by a Toronto-based Core Development Group Limited, which has promoted plans in the face of significant controversy to spend $1 billion buying single-family homes for the rental market. According to Mr. Clark's affidavit, his network of companies offloaded 223 of his properties to Core in 2022, which represents about half of Core's current portfolio of more than 550 homes. Of course, you know why it irks me. These guys want to spend $1 billion not investing in rental properties and building apartment buildings, which I think they should be doing, but buying up single family homes. And this is what we don't want. This is what drives up the price and makes it unaffordable, is corporations or guys like these that have leveraged other people's money with promissory notes and drove up the cost of real estate. So this was, again, this is the most disturbing part of this article to me. Let me continue. Core's Chief Executive Officer, Corey Houghton, said his company may explore options to buy some or all of Balboa Happy Gilmore properties out of the receivership. We hope to be part of the solution. We hope we can acquire the portfolio and keep the tenants in place, Mr. Houghton said in an interview. Mr. Houghton noted that when Core purchased the group of homes from Mr. Clark's companies in 2022, it paid off the mortgage lenders. So we have a big conglomerate or a big corporation buying up single-family residential homes and keeping them as rentals. He thinks he's doing a service to society. Of course, say that to all the people that can't afford a home right now, all the first-time buyers. I think they would disagree. And just one more article on this here. This is, again, from one of the small towns, the Sault Ste. Marie. Insolvent out-of-town landlords have been disaster for the community, Sue Mayor. Members of City Council sound off after a group of out-of-town shell corporations with 150 properties in Sault Ste. Marie obtained court-ordered protection from hundreds of lenders. And there at the bottom of this article, at the bottom of the screen, you can see a boarded-up home in Sault Ste. Marie, which I'm guessing is one of theirs. Dufour is concerned that the wave of out-of-town landlords swooping in to buy up dozens of properties in the Soo over the past years has taken away from the local economy while contributing to the erosion of affordable housing in the city. All that money is gone from Sault Ste. Marie now. The banks don't even have it, right? And it's a pretty significant chunk of money, he said. If those same renters had been either living in some of those historical, more affordable units or in affordable community housing units, all of that money would still be circulating in Sault Ste. Marie. So, of course, they are feeling the impacts in these small communities. When someone comes in and buys 150 or 200 homes in your small community, you feel the impact. And, of course, they do some cheap renos and they up the rent. And now, cost of living goes up. And now there's boarded up homes, derelict homes on these streets. So, people don't think about this when they're thinking about investing. People's, communities aren't at risk, but they are. And we're seeing that in these reports now. Anyway, let me know what you think. I've said enough. Let's go on. This week's video is sponsored by the Federal Housing Accelerator Fund, and here is one of their designs behind us that they promised to give. You can see here, it's a nice apartment building, basic finishes and whatnot. Just kidding. This video is again sponsored by you, the viewers. Thank you for watching, subscribing, and viewing. Let's move on to some statistics. First, I want to start off with the CREA annual price forecast. So what I did was I charted them out here for the last, since 2016, and the gray is their forecast, the average price forecast, and the red is how far they were off. The actual price, was it lower or higher? They're usually off. Like, it's hard to forecast, I understand, but I want to show you the pattern that I found. So going back to 2016, the actual price was, a little bit lower, so it was negative. And then the 2017, we were actually ended up higher. We were in a positive territory. We were actually 7.2% higher than they forecasted. Then we went back to a negative, positive, and then we went positive, negative 4.9, positive. Usually, with the exception of 2020, we flip back and forth. One year they're high on their estimation, next year they're low, except for 2020. Of course, we had the pandemic that started. So, of course, lately, where are we going? We went from 2022, they over forecasted, we came in under forecast, of course, with interest rate hikes and speculation dropped off. Last year, 2023, they under forecasted, we ended up higher. This year, I think it's going to be an over forecast, and we're going to end up lower than this if the pattern sticks to what it should. As long as there's no pandemics, I think it will, which again aligns with my narrative of falling house prices, especially towards the end of the year. Next, I'm going to get into the statistics from across the country. Not every area is in here. It's only the 6th of February, so many places haven't released their stats yet, one being, say, Montreal and Quebec and the East Coast. So again, a lot of places in here, but a lot of places are not in here. And anywhere that didn't have more than 100 sales, I didn't include. So a lot of places in Ontario and the more rural places, they're not included until sales pick up, because the data gets too dicey. It's not accurate when there's like 80 sales, right? It's very unpredictable, the data. Anyway, here are the month-over-month changes from December to January this year. Oakville and Milton down 11.2%. Toronto, the city of Toronto, down 7.7%. Brantford down 6.3%. Victoria down 3.2%. Barrie and District down 2.9, London and St. Thomas down 1.8, Peel down 1.6, Hamilton, Burlington down 1.1, York down 1%, Cambridge pretty even, Greater Vancouver up a little bit, but pretty even. Niagara region, where I'm from, up 1.2%, Guelph up 2.3%, Edmonton up 2.3%, or 2.5%, I should say. Kingston and area up 3.7, Durham up 3.8, Windsor, Essex up 3.9, Kitchener and Waterloo up 4.7, Fraser Valley up 5.2%, and the city of Calgary up 5.4%. So one thing I did want to just note, Toronto, the city of Toronto had 4 months of decline in a row. This is the first time in a while this has happened. Even during the pandemic, it didn't happen like that. They had 3 months in a row. So yeah, 4 months in a row of declines is pretty significant, and kind of just shows you how healthy or unhealthy the market is, especially with all these talk of bidding wars and whatever else you've heard on social media. Next, on to the percent change from the peak. Cambridge down almost 30%. Then Barrie and District, you can go down the line there. I'm not going to read all these off and bore you. Most places are in that 20 to 25%, almost everywhere actually. Until you get down to Victoria, they're down 16.4% from the peak. Greater Vancouver down 5.8%. Edmonton down 5.2%. And Calgary just hit a new high. The only one on this list, and the only one that has reported yet in January that hit a new high, they are up 3.1%, making all new highs. You guys, I don't know, pretty risky when you're buying at the top or at new highs. It's not a good feeling, and I don't know, be careful out there, Calgary buyers. You know, the economy will turn at some point and unemployment will rise, and you might be holding some bags there in Calgary at some point. Now on to the dollar change from the peak. Oakville Milton down 375,000 on average. Like, this is crazy. Down almost $400,000 on average for the average house in Oakville and Milton area from the peak. That's a huge decline. And like, we're almost at 400. No one in Canada has hit that $400,000 average monthly loss or month over month loss from the peak. But anyway, Oakville Milton looks like they're going to be close very soon. They probably will pick up in the spring, but once we get back into the slower months, I think you're going to see 400,000. Obviously, I think you're going to see more, but you're going to see that sooner than later. Durham region down 335,000, Peel down 329,000, York down 327,000, Cambridge down 313,000, Toronto, City of Toronto down 291,000, Barrie District down 279,000, Fraser Valley down 274,000. These are all big losses. Then you get Guelph, Hamilton, Burlington, Kitchener, Waterloo, London, St. Thomas, Niagara region, Brantford, all over 200,000. Faring the best is the Edmonton area, sorry, Greater Vancouver down 77,000, which isn't a lot for their area. Edmonton down only 22,000. And of course, Calgary, all new high by 17,000. Last time they hit an all new high, it was by like 1,000 or two. This time it was by 17,000, pretty significant. One more chart while we're on that subject. The GTA just hit a new low since the peak this January, and it's actually a 36-month low. You'd have to go back to January 2021 to get lower average sale price for any given month. This is not just for January. This is any given month. So they did hit a new low in the GTA from the peak, which is pretty significant also. And lastly, the market balance from the areas. So Victoria, Barrie District, Greater Vancouver, and Kingston and area are in a buyer's market when it comes to the sales to new listings ratio. In the balanced market, most places fall in the balanced market that I reported on this week, and you can see them there. And Durham region and Edmonton are in seller's market. And of course, Calgary with their new highs are in an overheated seller's market. Anyway, that's it for this week. Thanks for watching, and I'll see you next time.